America released the results of their latest industry survey on fund managers, which reveals a pretty tepid outlook on the macroeconomy, according to those who filled out the survey. Now, in their April edition of the FMS survey, Bank of America polled about 180 industry insiders who collectively represent almost $550 billion in assets under management. And what the survey manages to do is capture the anxiety present on Wall Street today. 93% of the fund managers polled predict a recession within the next 12 months. Now, in terms of recovery sentiment, over 50% of the survey participants expect the markets to struggle through not a V-shaped recovery, but a U-shaped recovery, indicating that they feel the economic mood was going to remain sour over the next several quarters, while only 15% of the managers expected a sharper V-shaped rebound and recovery. Now, SPY has seen a pretty good relief rally in recent weeks, gaining more than 26% since March, despite the ongoing pandemic. But uncertainty, of course, still looms in the equities markets and other risk on assets, giving the possibility of a prolonged shutdown and widespread unemployment. Clearly, the majority of these executives and fund managers feel that there is still more bad news to come. A survey also noted how mounting economic concerns are driving fund managers deeper into cash, so-called cash levels, which is the amount of cash that a fund will hold. And so, obviously, here's the thing. For those of you who might be a little confused, sitting in cash is not something that investors or traders want to do. Cash is not an appreciable asset. Cash is cash. It is one. It is one. It is one yesterday. It's going to be one today. In a year, it's going to be 0.97. You get my point, right? It is not. It's going to be a very stable, static number. It's not going to spike up dramatically, right? Unless you trade it against another currency, for example, right? Trading foreign currencies. So sitting in cash is something that investors absolutely do not want to do. Investors want to have their funds invested at all times. And when you give your money to a fund manager or a portfolio manager, or if your 401k, right? When you set up your 401k, everyone here has probably set up a 401k or some type of retirement account at your job or on your own. And your manager is going to ask you, your portfolio manager, your contact manager, or the automated web app that you use to fill out your situation, to fill out your portfolio, is going to ask you like, well, what's your risk appetite, and what's your, how many years do you have left till retirement, and how much money do you want to hold in cash so that you can buy up dips? And realistically, almost all of the default cash level options are about 1% or less, right? Because it doesn't really make a whole lot of sense to be sitting in cash when you could be invested into the market. Unfortunately, fund managers and the entire ecosystem around portfolio management in the United States particularly is completely biased to the long side. And why wouldn't they be? The traditional markets have been in a bull market. I mean, really, if you just macro out a bull market for the last 100 years, right? Every dip continues to go up. Yes, there are periods in time where the market goes down quite a bit, but as long as you wait, the market goes back up. And Bitcoin has been no different, right? There's never been a point in time in Bitcoin's entire history where if you would have just waited, you would have made money, right? There's nothing but unrealized losses until you sell. So fund managers almost never sit in cash. They're almost always long only, and that cash exists to buy dips. Obviously, the more these types of fund managers or hedge funds are going to be more complicated, where they will utilize tools like futures, options, short sells, things of that nature. Most typical fund managers, like your Fidelities for almost all of their retail clients, and your Vanguards, all of the stuff, it's just going to be completely biased to the long side. They're not going to act like, try calling up your portfolio manager at Fidelity for your 401k and telling them that you want to sell some stuff and that you want to short sell the S&P. And they'll likely tell you first they'll tell you that you shouldn't do that. And then they might not even be able to facilitate that trade for you, right? That's how brainwashed and long biased these individuals are in traditional markets, right? But cash levels, which is the amount of cash that funds are holding, has spiked to about 6%. And that is a figure that we have not seen since September 11th, 2001, right? Now, indeed, a flight to safety, or this exodus to safety or safe haven assets, was at the top of the minds of these fund managers they polled, with the most crowded trade. Most crowded trade means what is the trade with the least slippage, because there's so much liquidity, there's so much competition to enter into the market. The most crowded trade among the group was identified as long U.S. Treasuries for the second month in a row. Meaning, I mean, U.S. Treasuries are considered a safe haven asset because you are, when you go long U.S. Treasuries, you are essentially, betting that the United States government will cover its debt. You're betting on the United States government. It's been a solid return on yield for as long as the United States government's been around, which makes a lot of sense as we've been covering the 10-year Treasury note being pushed to record lows since this crisis really kicked off last month. So not only are they investing in something that's stable and secure, they're also buying the actual security for a fairly cheap price, indicating that even among professional fund managers, the fear, uncertainty, and doubt is still there, even as more aggressive fund managers are just, business as usual, buy the dip, buy the dip, buy the dip. So what do you guys think? Do these big money managers have the inside baseball, and are they wise to wait the market out for another possible dip from this looming recession, right? Or do you think this crisis is overblown and on the way out? The life is returning to normal soon enough, particularly with the talk that governors are kind of especially here in the United States, the governors of certain states are kind of bucking the trend and actually talking about reopening the economy. Forget what the federal government says. And these last few weeks have mostly been a buying frenzy. So do you consider these last few weeks a buying opportunity? Or is the buying opportunity not even here yet, right? Let me know you guys' thoughts in the comment section down below. We'll cover this when we get into the market analysis a little bit more.